Alrighty, welcome everyone for
This
joining.
meeting is being recorded.
Great. Good evening, everyone. Thank you so much for joining us. Welcome to the LA South Chamber Financial Wealth Team and our webinar tonight. We're excited about our evening and our guest speakers. We're going to go ahead and get started. My name is Oprah Price, and I'm with the LA South Chamber of Commerce. And I am also a board member with the LA South Chamber. The name of my business is Insurance Solution Services. And we are here to learn a great deal about Medicare tonight, as well as for open enrollment, as well as Covered California from one of our first guest speakers. But before I do that, I would like to introduce to you Vernell Taylor. Vernell Taylor is one of our also board members with the LA South Chamber. She is also with US Bank. And before I say anything else, I'm just going to give her the floor. So Vernell, take the floor. Thank you for joining us tonight.
Correction, thank you, Oprah. I'm with the Union Bank.
Uh-oh.
Yes,
I'm ahead of
thank you.
myself.
Thank you, Oprah. So Oprah gave me she introduced me. Thank you very much for joining, everyone. Again, I am Vernell Taylor, and as she mentioned, I am a member with the LA South Chamber of Commerce. I'm also on the Hope Foundation board, and I'm including the finance team. So thank you for joining this evening, and I am with Union Bank. So tonight we have two presenters that will be presenting, and I will be introducing our first speaker. I would like to introduce our first presenter. He is an insurance agent with RHJ Insurance Agency. He is one of our newest members with the LA South Chamber of Commerce. And he has a passion of supporting our community and ensuring that we are covered with the right benefits and insurance. Tonight, he will be discussing and presenting Covered California Medicare, open enrollment. I would like to turn it over to Rickey Hodges.
Well, thank you so much, Vernell. I appreciate that. That was a wonderful introduction. I really appreciate it. Thank you to the team here tonight as well for this opportunity to present and to share some information with our community. And I look forward to also hearing Guillermo's presentation. So tonight, we're talking about Medicare and Covered California. And we'll get right into our slides. As everyone may or may not know, open enrollment is going on now from October 15th until December the 7th. And so one of the big questions we always get, what is Medicare? And so I'll give you the definition directly from the Center for Medicaid Services, but Medicare is a federal insurance program administered by the Center for Medicare and Medicaid Services, or CMS. Social Security offices process applications for Medicare. It can also provide you with general information on it. Who's eligible for Medicare? Those typically, we think those who are 65 or older, which is the case, but there are also those eligible for Medicare who may have permanent disability. So if you're below 65 or under 65 and you have a permanent disability, you can get SSI, then you will also be eligible for Medicare. Age 65 or older, or if you or your spouse have worked and paid Social Security taxes for at least 10 years. So they want to get your tax money out of there. A permanent resident of the United States and a legal resident. So we're going to go over on the next slide the four parts of Medicare. There we go. So parts A and B. Part A is your hospital insurance, hospital stays, skilled nursing facility, hospice care, and some home health care. Not a lot. There may be some available depending upon the plan or the coverage that you have. Part B is your medical coverage, your doctor services. You're going in for your preventative cares, your yearly checkups, surgical services, supplies, clinical lab tests, durable medical equipment, your canes, your walkers, and preventative services. Part B, medical insurance. You must have Part B if you want to join a Medicare Advantage plan, which we'll talk a little bit about more on the next slide, which is actually Part C. Or if you want to buy a Medigap or a supplemental insurance plan, which is also available if you're eligible for TRICARE or your employer requires you to have that coverage. Part C, What is Medicare Advantage? You see it all the time when you may be watching TV, call in and you have like William Shatner and all these different stars, on the TV. Those are typically Medicare Advantage plans that they want you to call in. So you must be enrolled in Medicare Parts A and B, and you must live in a specific plan area. So different plans, it may be available here in LA County, but it may not be available in Orange County or San Bernardino County. So each county has specific plans for those counties, and some are the same and some are different. So Medicare Part C combines both Part A, B, and in most cases, Part D, your prescription drug coverage all into one, and they're offered by private healthcare companies. So all of your Anthem, Blue Shield, Aetna, all those companies, they all offer Part C Medicare Advantage. Oftentimes, Part V or Part C plans offer benefits like routine dental, very basic dental, vision, hearing, may also include wellness services such as gym or membership, Uber rides, and other services that those plans may offer. Part D, available with all Medicare Parts A and B through private insurance companies. This is where you get your prescription drugs. If you have any ailments, you have any medical problems, you're likely going to need some form of prescription, and so this is where your Part D comes in. So Medicare Advantage plans, or MAPD, cover both medical and your drugs and your prescriptions. Can be used with original Medicare. So you don't have to have a Medicare Advantage plan in order to have Part D, but there is a premium associated with both Part B and Part D, but the Part C sometimes covers your Part D premium. Part D benefits do not impact Medicare A or B coverage. It's important to enroll when eligible. So going 63 days without coverage can trigger a late enrollment penalty, which we'll talk about a little bit more shortly. Extra help. A lot of folks don't know that there is help available out there for you in Medicare. You may, I know I meet with a lot of my customers, and they're struggling to get their prescriptions paid for. One of my customers was paying $130 for a particular medication. We were able to apply for the Extra Help program based upon her income, based upon her assets. And now that 130 is now like $2 and some change for the same medication. So it's important to know that these plans are there. They're available for you to apply. Very easy. Maybe takes about 10 minutes to go on the Medicare website and get that in. It's extremely helpful. So it helps pay for Medicaid and Medicare costs, pays Medicare premiums, may reduce deductibles and coinsurance. Income amounts change each year. So this year you may not qualify, but in the new plan year, you may qualify. So just because you were denied in the past, I always encourage people to apply. The worst they can tell you is no. One thing we know is you won't get it if you don't apply. So at least allow them to tell you no and to see what you can do. What extra help is out there? Help paying for your Part D prescriptions. Social Security or state makes the determination. So you may automatically qualify if you get both Medicare and Medi-Cal. Or Medicaid. In California, we call it Medi-Cal, but on the federal level, it's called Medicaid. And so we call those Medis, but also you'll hear it referred to as duals. Supplemental Social Security income, SSI, and these are just a few of the ways to qualify. So again, I encourage everyone to apply. You could apply, or someone else could apply for you to get that taken care of for you. Enrollment periods. Your initial enrollment periods last 7 months, 3 months before your 65th birthday, and 3 months after turning 65. Okay. Special enrollment periods. Your special enrollment periods, if you're still working and have group coverage, through a spouse, you can enroll anytime while you're still covered by the group plan, or within 8 months of loss of coverage of it from your group plan or termination of employment, whichever happens first. But it's still important to make sure that you meet those time frames, because there are penalties associated for failing to enroll on time. The general enrollment period for those who did not sign up for Part B or Part A during their initial enrollment, you can enroll from January 1st to March 31st annually, but coverage will begin on July 1st, and there is a 10% penalty for each month that you're supposed to enroll, but you don't do it. So please, 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 sir, please, ma'am, please enroll when you're supposed to. Annual enrollment period, which is now October 15th through December the 7th of each year. You may switch from original Medicare to a Medicare Advantage, or from a Medicare Advantage to original Medicare, and your coverage will begin on January 1st of the new year. Okay, so you see that you may be going to Walmart or CVS, and you see folks sitting at the table with their laptops. Those are folks who are enrolling in Medicare. Part B premiums. So if you're on Medicare, everybody is going to have to pay the Part B. Whether you have original Medicare or whether you have MAPD, you're going to have to pay Part B. So this graph breaks down what the premiums are. If you made $97,000, and I'm only going to go off of single, but you can see if you're filing joint or if you're married. But if you're an individual and you make $97,000 or less, your Part B premium is going to be $164.90. 97 to 123,000, it'll be $230, and so on. So you can see here in the far right in the bold section, where your income may fall and what your premium may be. It's important to know about this, that your income may have been high while you were working and be a little bit less when you go into retirement. So initially, they're going to give you whatever it was that was reported to them last. And it'll be upon you to go to them and say, hey, I no longer make, $500,000 a year. I can't afford a $560 a month Part B premium. So you have to go down to Social Security office, provide the proof of income, and then they'll begin to meet you where you are to give you the appropriate Part B premium. So that's that for Medicare. Covered California. There are about 1.6 million active Covered California members statewide. Nearly 13 more folks are covered by Medi-Cal. Okay, half of the people who are on Covered California are seeing a savings of $500 to $600 in their premiums per month. And most people, according to the statistics directly from Covered California, pay for plans that are about $1 per month. And so there's been a lot of misnomers about Covered California. Oh, I don't like it. It's not. It's the same exact health insurance that you would get if you went directly through Kaiser, if you went directly through Anthem, or if you went directly through any of the healthcare companies. It's the same exact health insurance, but they're just assisting you with the premium, with your premiums by a subsidy, depending upon how much money you make, depending upon how many people are in your home, depending upon your situation. So there's just so many different variables that go into assisting you in obtaining a subsidy for your coverage for Covered California. You cannot be denied coverage, which is great. There are no lifetime limits on how long you can stay in the hospital, so they can't come in and kick you out off the plan or out of the hospital. Children can stay up to 26 years old. They can stay on their parents' insurance plan. So I had a 26-year-old young lady call me today because she was just recently kicked off of her parents' plan. So she works part-time and she needed some good health coverage, so we were able to get her signed up. Most of the money paid for premiums must be spent on medical care and quality care and improvement activities. So you don't even have to pay. The premiums come directly from the state or from the federal government. So whatever your portion is, you pay that directly to the insurance companies, and you don't have to worry about the rest, which is great. And sometimes these plans are extremely expensive. You're talking $500, $600, $700 a month, for health insurance, where you can be paying $1 to maybe $20 per month. I mean, it's really, really great benefit to have. 6 steps to health insurance: shop and compare, apply, get help, review your choices, make your payment options, and congratulations, you're covered. And so I put that there because, I mean, it's really not a long process. You go in, you put in your zip code, you put in your income, you put in how many folks are in your home and how often you go and use your medical insurance. And before you know it, you have a quote of several different plans, several different companies of, what your rates are going to be, what they cover, how it's going to break down, what your co-pays are, what your out-of-pocket maximums are. It gives you a great glimpse of what you need. Financial help is available, as I said. Cover California may help pay for your monthly premiums. Federal and state subsidies are available. New federal and state financial help is available. They've passed a lot of new laws. They've actually raised this year in 2023, or going into the 2023 plan year, the requirements to get it have been lowered, which means more people will be eligible for Covered California. Whereas in the past, if you made too much, your premiums may have been a bit higher. But because of inflation, because of all the things that are going on, in the world, they've made it really accessible to the average person. Reasons for not having insurance. These are some of the things that people say. I'm just going to pray about it. I'm going to go to the emergency room to get my regular medical treatment. I mean, you're going in for a headache and you're going to the emergency room. You may sit there for, 15 hours. Whereas if you had health insurance, you'd be able to go to urgent care or to your primary care. A lot of people like to diagnose their own illnesses, at-home remedies, never been able to shake an illness. You don't know what's bothering you. We really need to, address our many excuses and begin to take on our health and take it serious, because it's tough. We were talking about this earlier. Health problems not only affect you, but they affect everyone connected to you. And so it's very important that we take our health serious and take our healthcare serious, and particularly when it's readily available to us, as it is for us in Covered California. And I want to address that last bullet down there. Medical bills could, bankrupt you. If it can put you out of business, it can mess up your finances, it can mess up your credit. So having a good health plan is extremely important. These are statistics straight from Covered California. It says that Blacks have the highest rate of any racial and ethnic group of cancer. Black women are 40% more likely to die from breast cancer. Black folks are 40% more likely to have blood pressure, high blood pressure. So these are statistics that Covered California this year that they highlighted. It wasn't anything that I picked out. I didn't pick out any one group, but this is what they're highlighting, and I wanted to share that with the group as well, because we really need to address these inequities. Get to the next slide. Enrollment calendar. Signing up for Covered California for the first time. Any Californian that does not have health insurance can enroll in Covered Californians through special enrollment periods. So I've been enrolling people in special enrollments through the COVID. You enroll today, and your coverage will be effective on the 1st of the next month, if you fall into one of the special enrollment categories. And there's so many that we just don't have time to go into today. So enrollment period began yesterday rather, and runs through January 31st. Renewing starts from November the 1st and runs through December the 15th. Individuals and families with low income may be eligible for no-cost Medi-Cal plans. The good thing with Covered California enrollers is that if you don't qualify for Covered California and you qualify for Medi-Cal, you can be enrolled right there. So you don't have to go down to the office. You don't have to wait in line. We can do everything right there over the computer, get you enrolled, get your documents submitted, get you and your family covered. And any questions, you can feel free to reach out to myself or to the team here with any questions that we may have. And that is the extent of my presentation, Ms. Opal.
Excellent,
Awesome.
Rick.
Go ahead, Vernell.
Yes, excellent. Good presentation, Ricky. We didn't get to see your face this time. However, you delivered well and great information. I want to know if there's any questions in the audience. We're going to take a few minutes to have a Q&A session before we go to the next presenter, Are there any questions or burning questions, information that you heard that you're not sure of, or something else came up and you didn't hear? Please take this opportunity to share your questions.
You can also put them in the chat.
Yes. Well, Ricky, I have one question. I can get it started. And you done pretty good, because some of the questions I had, you pretty much had the answer. One question I have, Ricky, can you get covered? Can you get covered California after open enrollment?
You can get covered California after open enrollment. You can get it due to special enrollment periods. So right now, public health emergency is the biggest one, right? So it's COVID-19. So monkeypox. So if someone needed health insurance after that enrollment period, absolutely. And again, if you signed up on the 28th of October, your coverage will be effective on November the 1st. And so it's just all about when you sign up. Just always know that it'll always be effective that next month.
Excellent. Thank you.
So Ricky, I have a question.
Yes.
So my question is, how can you avoid a penalty if you're eligible for Medicare? Say you're like 64, 65, but you still work, or so you're getting insurance via your employer, or perhaps through your spouse's health insurance plan.
So if you are still working or you're covered by your spouse's insurance plan, you're good to go. There will be no penalty associated for you as long as you're covered. So you'll have 8 months. So you have 8 months from the time that coverage ends to enroll to avoid any penalties associated with it. Because what you don't want to do is, if you're covered, have Medicare as well, because then you have to pay the Part B premiums. That's more money coming out of your pocket, and possibly the Part D premium. So it just makes sense to keep your health insurance through the spouse or through the through your job, and that avoids any penalties. You are absolutely a-okay. But if you go past that 8 months, then you'll have to go into the general enrollment period, and then your coverage won't be effective until July of that year, of that next year. And you'll be on top of that, it'll be 10% for each month that you did not enroll. So that's how you avoid it. But as long as you're working and as long as you're covered, you're good to go.
And
Right.
when you're 65, do you have to apply for Medicare Part A?
Well, if you're not covered, then you would need to. I wouldn't say you have to, but I would say you would probably want to, because unless you have any other coverage, then you're going to go to the hospital and not have any coverage and have a huge bill.
Okay.
Ricky, I have a question also, and I'm kind of glad you answered that for Lorraine, because that was one question that I had. So that they're still implying the penalties if you don't have the coverage on Cover California. Okay, great.
Well, for Cover California, yes. The penalty, I believe that the penalty for Cover California for adults, if you don't have it, is like $850 a year for adults. And I want to say it was $400 for children. So it's important, because when you go and file your taxes, they're going to ask, hey, were you covered? And if you weren't, it's going to take a bite out of that income tax check. So it's important to make sure that you have it.
You do have the proper coverage.
Yes, ma'am.
Okay, I had another question in relates to Medicare.
Yes.
Okay. Can you briefly explain to us, to the audience, the difference in an HMO and a PPO program? I know in a lot of the plans, it's been, they've been offering it just HMOs. I know they're trying to come back with the PPO. So can you just dwell on that just a little bit?
Absolutely. So an HMO, I guess the example I would give would be Kaiser, right? So you go to Kaiser, and Kaiser, I would say, does a great job at being an HMO. Everything is in one place. Your pharmacy is there. Your primary care doctor is there. Your specialist is there. The hospital is, I mean, everything is in one place. But that's the thing, everything is in one place. So with an HMO, you pick your primary care doctor, you pick the the medical group that you would like to have your services at, and all of your services are controlled essentially by your primary care doctor. So if you want to go see a specialist, you will need a referral from your primary care doctor. Now you can go outside of that Kaiser network if you want. However, they won't cover it. You'll likely be responsible for 100% of the coverage or the fees associated with going outside of the network, as they call it. Whereas with the PPO, you have a little bit more flexibility. You can choose your doctor, you can choose your specialist, you can choose your pharmacy, you can choose if you want to go to a doctor and you have a PPO, you want to go to a doctor in Texas and you live in California, you have a little bit more flexibility, whereas you don't need the referral, but there's also a difference in costs associated with it. HMOs will keep the cost down a little bit more, whereas PPOs will probably be a bit more expensive because you're essentially paying for your freedom. Everyone's decisions are different and the reasons are different based upon what works best for you. What works good for me may not work good for you, so you have to make the choice as to what works. But the HMO is a good fit depending upon the plan, depending upon the company, whereas the PPO just gives you that freedom of choice as to where you want to go. And there's also hybrid plans as well called point of service plans, which are fixed, and it's an HMO. You pick your primary care doctor, but you also have the option of the PPO to go outside of the network for a higher cost, but it gives you that option and that choice of having those options available to you.
Great. Thank you so much for answering. Any other questions from the audience?
And I'm checking the chat box. I see any questions. There's one from Maria. She wanted Rickey to give his information, contact information. Maybe he can share that in the chat box. Or
absolutely, I'll put that in the chat box in just a little bit.
Excellent. Okay. Thank you.
Very good. At this time, we want to thank you so much, Rickey. Awesome presentation, and I hope that was helpful to a lot of people in getting information on Medicare, how to enroll, and also cover California, because they're both important to have. At this time, what we'd like to do is to have our guests that are on tonight, just really quickly, we want you to introduce yourself, okay? And just give us just the name of your business. We'll have time to do that. So I'm going to start with Jean Cleary, is that correct? You want to unmute yourself?
Jean Clary, and I'm a retired teacher, so I'm not associated with the business at this time.
All right,
but I do have all my coverage, my medical coverage with Kaiser HMO, because my employer supplies that.
Oh, okay, very good. Well, we thank you for joining us tonight, okay?
Thank you.
And again, we have Linda Sam.
Opa,
are you with us?
Opa.
Yes.
I just wanted you to know that Jean Clary is my guest.
Very good. Thank you for being with us tonight. Awesome. Okay. Delphine, you want to introduce yourself? Pruitt?
Yeah, I'm sorry. I was on mute. Yes, Delphine Pruitt, U.S. Bank, and a new member of the Finance Committee.
Very good. Thank you for joining us tonight as well. And I also have, I hope I say this name correctly, Akasha. Is that correct?
No, it's Akosia, and I was invited by Jean Clary. I'm a retired educator.
Very good. Okay, very good. Thank you for being with us tonight as well.
You're welcome.
Thank you for joining us. Michael. Did I do that, Michael? It said Michael.
Oh, but that is
Is
actually,
anyone-
no, that's Lorene.
Okay. Very good. Well, we're going to keep moving forward. Thank you so much, Guillermo. We're going to go ahead and move forward with our next guest speaker. And he's talking right now. Okay. Guillermo Saade is a financial advisor. He is with Edward Jones, and he is going to see what happens when you put your picture up there right away, Guillermo. Okay. And he is going to speak with us tonight in regards to the market, and just kind of give us an overview of some of the changes and what's been taking place over the last year or so, and even in the current months. So without further ado, Guillermo, you have the mic.
Hi there, my name is Guillermo Saade. I'm a financial advisor with Edward Jones. I'm gonna go ahead and put in my contact information for those of you who would like to contact me. Edward Jones is not quite as well known here in Los Angeles, but we're actually a 100-year-old company. We're the largest financial services firm by number of offices because we have small offices spread out in the communities that we want to serve. My focus area is South LA, but I really have clients everywhere. So this evening, I'm going to be talking about the all-important topic of, well, the economy, investing, what it means to invest. So I'm gonna, unfortunately, the host has disabled participant screen sharing. So I am not able to share my screen.
Just a second, Guillermo. I can let you share your screen, okay? I will help you with that. Just give me a second here.
We've now started seeing your screen.
Oh, no, and that's not good. Okay, I'm trying to get out of there, okay? I think Dexter's has it. He's gonna share from his end. You're good. You can go ahead and share your screen.
Okay. So I am gonna skip several of these slides because it does go into a lot of information. Now, quick disclaimer, just real quickly. This person, by the way, I work for a company. Everything I do has to be compliance approved. So the presentations have to be complete. So I can't just simply delete slides, although I sometimes would like to, but just because they tend to go into a lot of information that may not be pertinent for the vast majority of us. So again, talking about the stock market, post-pandemic economic trends, inflation, a look under the hood of the equity markets, outlook for bonds and interest rates. So equity markets, that's just a fancy word of saying the stock market. I'm gonna skip over that. We're gonna go straight to wage growth. Why is wage growth important? Because wage growth is a strong determinant. If the Fed starts seeing that unemployment starts to increase, they're going to put the brakes on interest rate hikes. Right now, we are still at significantly low unemployment rate and wages are increasing. So, of course, this puts the Fed is a central bank, right? They have to balance increasing interest rates to put a brake on inflation, while at the same time trying to prevent a recession. So that's why this is pretty important. And as you see here, historically, and you can see the huge blip that COVID caused. But historically, wages go down, unemployment rate goes up, and vice versa. The yield curve is important, and I won't go too much into this. It tends to be an indicator of when things go negative. In other words, 10-year yield minus the 2-year yield should be positive. When it goes negative, it is an indication of a recession. So it's not a huge indicator right now, but it is a cautionary one. So one of the things that we tend to look at when it comes to the economy is, can inflation be brought down by increasing rates? So right now we are starting to see that, there is still another large rate hike expected before the end of the year. But the key thing is for folks, just as the average person, to have enough in emergency funds. And I can't stress this enough, because this presentation could also be called Preparing for the Unexpected, because that's really what Rickey also spoke about, right? We want to prepare for the unexpected. So regardless of what the economy does, we want to have an emergency savings. So nonetheless, so I want to remind folks, just be consistent with your long-term goals, regardless of what inflation and the news says. So as inflation starts to peak, the rate at which interest rates are being increased will slow down. So the stock market will likely want to see several months of moderating inflation before it accepts that there is no need for monetary policy to become overly restrictive. All that means is restrictive means higher interest rates. So if the market sees that there is a stretch of moderating inflation, that'll be a key catalyst for the stock market to come back up and your investments to come back up. So I'm going to talk a little bit. I'm going to skip over the slide about cars, but very important. Housing prices is very important. If you remember 2008, what housing and real estate was a key component of the decline. So right now we have housing units have just been on the decline, and really for a while, right? So and now housing prices have really come up. So it's really, some folks have blamed this on actually, ironically, lower, very low interest rates for a very long period of time. So now we all know higher mortgage rates means that the average buyers, many people are being priced out of the market, while some sellers are trying to cash in on the higher prices. So the higher prices for homes drives one of the inflation factors. So we are watching several housing indicators that might signal that prices have started to or the increase has started to come down. So let's talk about this one here. What is the S&P 500? The S&P 500 is an index that makes up a lot of companies of different sizes, hence 500 firms, that it provides a gauge on the general stock market. So earnings, price to earnings, that just means, is the stock market a good deal? If you go to Ross, you go to Marshall's when you hear that there's a sale. Nobody goes to the stock market when people when things are on sale, ironically. They actually flee the stock market when prices decline. We kind of remind folks, well, isn't this, that's kind of like the inverse psychology, right? So price to earnings ratio have declined. Now remember, what makes up the performance of a firm? Well, it's earnings and also margins. At the end of the day, we all want to do well, but if companies and corporations don't do well, they don't hire, and the overall economy suffers. So that's the part that's kind of tough. So last time markets fell from these levels, last time markets fell from these PDE levels was in the late 1990s through early 2000s. But just because valuations, meaning price to earnings ratio, have fallen doesn't mean there's no support for stocks going forward. So earnings growth has still been a strong tailwind for equities. So that means that if companies continue to do well, the stock market will come back up. So slide 17. So we do think that earnings growth, and again, we're talking about corporate earnings growth, will continue to provide a solid base for the stock market. And guidance still looks bright. As this chart shows, recent forward earnings estimates have softened only slightly, but they still look to grow through 2022 and have helped and into 2023. So so as a company, we always say, if you have investments already, try to hold on tight and don't get fearful and reactive. If in a situation like 2008, though, it was very different than it is now, because in 2008, the stock market declined, and at the same time, unemployment skyrocketed. So the overall economy right now is doing well. Is just inflation is this extreme thorn. So I'm going to chat a little bit about, instead of going into bonds and mid cap and different things. Well, I am going to show this chart real quickly. So the point of this chart is to show how we want to have, we put together a diversified portfolio. So you probably heard the term diversification. Well, we always say, why do you want to put your eggs in one basket, right? So some areas are going to be underweight, meaning there's opportunity. Most areas right now are neutral, and some areas are overweight, which means there's a chance for continued decline. But I am going to talk a little bit about, instead of going into more of that, so I am going to talk a little bit about the pulling up this report. It's our latest fourth quarter outlook. And again, because the presentation was put together in early April, a lot has happened since then. All right, I take it back. I think it was put together in late May. So again, going back to this is how well things have done or how poorly, depending on your perspective, right? 3-year annualized rate, right, means, oh, okay, you have to look at things kind of in the long term, right? And so there are sectors that have really done well, and there are sectors that have done really poorly, even for the 3 years. And I always remind my clients, don't look at the quarter, don't look at the month, really look at annualized returns for more than 2 years, because that really gives you an opportunity to look, the stock, again, equity, same thing as stock market rally early in the quarter quickly reversed. Market found new lows towards the end of at the end of September. So earnings results have been mixed. So again, earnings drives market price, etc. But we do expect continued market volatility to continue until inflation makes a significant progress to the downside. So what that means is as inflation starts to decline, then the interest rate hikes will start to decrease, and the overall economy and stock market will start to improve. So this chart just shows how the stock market has performed, with versus real GDP. So that's the economy change. And it just shows how they've always been in lockstep, 6 months, advanced by 6 months. So that means that it's moved over, meaning that the stock market always reacts first, and then the market follows, right? So a good example is 2008, where the stock market plummeted, yet things really continued to drag out in 2009. Things were still really, really in the doldrums, even after the stock market started to increase. So again, inflation holds key. So the inflation will determine the direction of the stock market. The Fed will likely want to see 3 or more lower inflation readings to signal a pause. And Edward Jones, we believe inflation will start to moderate in the fourth quarter, driven by improved supply-demand dynamics, but only gradually and not in a straight line, of course. So nothing in the economy is a straight line. So once central banks, one of them being the Fed, and of course you have the central banks in Europe and Asia, become less hawkish, that means they slow down the rate of interest rate increases. Both equity and fixed income markets are likely to mount a sustainable recovery. So this is a chart that shows, again, history, because that's what we rely on, right? So stock market performance has performed well after the Fed has stopped hiking rates. So this is the stock market return 12 months after the last rate hike. So the exception, of course, was early 2000s and early 1980s, but the others were really, really strong. So that is it. I don't want to continue with too much. I wanted to point out just the importance of, I'm going to just point out the importance of keeping, and also, I can't talk about stock market without talking a little bit about politics and the midterms coming up. So what we always emphasize is, regardless of party, we always say, at the end of the day, the stock market likes stability. Stock market has always done well, typically after a midterm or after a new president. So it's really regardless of party. So again, we're talking about the stock market likes stability and predictability. So when things are crazy, the stock market goes wild, right? So I just say we have a motto that says keep politics out of your portfolio, meaning that if you're consistent with your financial goals, your political preferences should not drive how you feel about the stock market. But obviously it's easier said than done. So that is it for me. I'm going to leave it there.
We have some questions.
Oh, let's see. Oh, we have
Yeah, there's
questions. You have a lot of questions. Okay, this is great.
Guillermo. Question from Rickey Hodges. In regards to the housing market, how much do you believe the market will fall and when?
That's a great question. I don't have an answer for that right now. I'm gonna have to ask. So let me say this. So we have economists. We as in Edward Jones has economists that dig deep into these things. So and I send out a market update. I think a few of you might be on my market update weekly emails. If you want to be included on that, I definitely can send those to you. So this presentation, as well as the market updates, they are actually prepared by economists. A lot of them are actually, they have their CFA, which is called Chartered Financial Analysts. So my role is to learn what's most important to you and to become an expert with the client. Their role is to tell us they're an experts in the market, and they tell us how it affects our role as a financial advisor. So I'm gonna write that down and get back to you.
Thank you. I have another question from Terry Larry. What are your thoughts on bonds?
So there's two things. So bonds right now are increasing in rates significantly. The problem with bonds is there's different rates. Different terms. You have short-term bonds, medium-term, and longer-term bonds. You don't want your money tied up for a very long time in an increasing rate environment because, well, I just put 5,000 into a bond that's tied up my money, and now rates are higher. They're going to be higher in 12 months. Right now, we are actually suggesting, instead of bonds, short-term CDs. Because our short-term CDs, at least at Edward Jones, they're paying better than some of the longer-term bonds. The other thing that some folks are using is bond funds. And that's just simply a mutual fund that only invests in bonds.
Thank you. Good questions. I'm going to ask a question, then I'll get the next question in the chat box. What is Edward Jones advising clients, prospects with new investable assets in today's market?
What are they advising in terms of new investable assets?
Yes.
What do you mean by new investable assets?
So obviously maybe new monies or anything they like to invest in today's market.
I see.
How is Edward Jones advising the clients or prospects?
Got it. If I'm understanding, so new assets could be new money, maybe from the jackpot, the Powerball. So the first thing we look at is, do you have enough for an emergency? So if you have money that you have set aside, or newfound money, let's say, and you have no emergency savings, well, guess what? That's your new emergency savings, right? What is emergency savings? That's 4 months, well, at the very least, 4 months of monthly expenses. So if your average monthly expense is, say, $3,000 a month, then you should definitely have $12,000 in something that is either in a CD or a money market. Then we evaluate the client's risk tolerance. So from 0 to 100, if somebody has a 50 out of 100 risk tolerance, we put together a portfolio, typically of funds, mutual funds and ETFs. Depending on the size of the account, we might put in individual stocks. But we look at how long have these funds been around. We choose funds that are from our fund focus list, and we put together a portfolio that's two things: in line with the risk tolerance, but also diversified. So you don't want something that is just in one You don't want only energy stocks, or you don't want only consumer stocks. How can an investor maximize the so that's a great question from Lorene. So again, it depends on Michael's risk tolerance. So if he has a higher risk tolerance, there are areas right now that are more of an opportunity, right? So there are more consistent areas as well. So again, a lot of folks are into real estate investing and they may not have enough money to buy a house, as an example. So what do? They actually buy into REITs, a share of a REIT, real estate investment trust, because a lot of folks are huge fans of it. They're like, oh, real estate is always does well. So again, we put together a portfolio that's fairly diversified, but might include things that are in line with whatever the client is interested in as well. It's kind of a difficult question to ask without knowing Michael's risk tolerance. Though, again, if he has a very low risk tolerance, just put your money into CDs. That's very safe.
Excellent.
Opa?
We have one question for Lorraine, and then Opa has her hand up. Lorraine, question for Lorraine: how can consumers protect their money during inflationary periods?
Oh, I apologize. That's the one that I had just answered. And again,
okay.
Depends on.
Okay, thank you.
And
Opa? Thank you.
Yeah.
Okay, yes, I have a question, Guillermo.
Mm-hmm.
Through Edward Jones, for customers that have first-time money and they want to do first-time investments, does Edward Jones investment plans or strategies offer any type of a bonus for new monies coming into a program?
I don't understand when you say bonus.
Well, okay, I know I do what they call tax deferred annuities. And we do have a line in the portfolio where, people can put money in and then they may get a 5% bonus on their money. So I'm just wondering on any of the programs, because I know it's on the market. Are there any incentives?
Yeah, they're not. So I guess the term bonus, I haven't heard that term before, but
Okay.
we do sell tax deferred annuities, right? We have both variable and fixed annuities. The bonus is, I guess the term bonus is a little confusing to me, because fixed annuities are very simple products, right? They're not, they're very simple. You put your money in and it grows at a very fixed rate, and it can be either annuitized, or you put it in every month, or you put in a lump sum. In a variable annuity, the money is actually, again, still tax deferred, but the money is tied up into the stock market.
Okay.
The bonus part, perhaps you mean an increase in interest rates, or?
Well, they get a bonus on, let's say I'm going to drop $10,000 into a tax deferred annuity. Okay.
Mm-hmm.
Through some of the products out there, you can get a 5% bonus on your money, or you get a 3% bonus, and there's some that have a 10% bonus.
And this is in addition to the regular interest rate.
In addition to whatever monies I put there, but it has to be in that period of time that money's going to be into that fund.
Oh, got it. There may be some products out there, particularly on the fixed annuity side, probably not so much on the variable annuity side.
Okay.
And
I know not on the variable, because that's on the market. That's on the fluctuating market.
Right, exactly. So
Okay.
I think they may term it a little bit different, but I'm gonna reach out to my annuity department and ask.
Okay, great. And I do have another question, but did someone else have another question that they wanted to ask?
I'm checking the chat box. No more questions unless someone has some question. Then go ahead and load them up in the chat box. We appreciate it. Thank you.
Okay, my last question. with the market being in a downswing, and I know that's been the situation for the last year or so, does Edward Jones offer the clients an opportunity to either move their money or to move it around during that process? What do you guys offer
So,
as to keep people from really taking a big dive?
well, so when you say moving your money, so most investments are liquid. So,
I mean,
that-
within Edward Jones as an advisor, when you see that your client is struggling with that account, are you
Yeah, so
offering them
typically, okay, so if a client comes to me and says, oh, and I have one particular client that calls me pretty often saying, I'm nervous, I can't, this is my whole life savings and everything. So one, this is a retirement account that we're talking about. So I say, whatever you do, sir, you do not want to pull out your money out of your IRA. But what we can do is exchange your mutual funds for CDs, right? So
okay.
So moving money around inside of an account is of course easier. Moving money from account to account is more difficult because now you're talking about the potential for tax implications. So we don't recommend, you can though, but we don't recommend, for example, just saying, oh, I'm panicking about the stock market, I'm going to take all my money out of a retirement account. You definitely do not want to do that unless you really, really need that money, because now you're having to pay taxes on that.
Right. Okay.
And possibly a penalty if you're not 59 and a half.
Right. Okay. Well, I meant it kind of like, when the market takes a dive, and I know clients do get really nervous about their money because it drops. I've had clients lose, would express to me that they've lost, $10,000, $20,000 at a time. But I'm saying, does Edward Jones offer as an advisor, to help them protect that money? Is there some way they can, move?
Well, I guess, what do you mean by protect their money? Like,
as it is, if it's already on, if it's in a variable annuity or if it's in a market fund, it's on the market. So it's open. It's there for, we understand we're going to take that dive. But is there any way that, as an advisor that you can advise them, we can move it to this fund until, the market gets a little more stable? Okay, so that's what
absolutely. I'm asking. So there's a wide range of investments here. So now, because when you say protect their money, so you can protect your money by putting your money into a CD.
What I mean by that is help stop some of the bleeding.
Yeah, and that's exactly how we would help for this particular client that I was talking about. We help to stop the bleeding by putting the money into several. Now his IRA is now about 40% CDs. So if the market continued to decline, the CD portion is fixed. That's protected. But I also remind him, oh, and by the way, if the stock market, not if, but when the stock market recovers, whether that's in 6 months or 12 months, the CD portion won't recover as fast. It's fixed. If it's a 3.5% CD, that's it.
Right.
Guillermo, do you also have cash management accounts as part of your portfolio where you can actually shift some of the client's funds into that account, and he does not have to worry about locking the money into CD, but he's still in a way, I think, protected from bleeding?
Income, one product is called Income Manager.
Right.
But it's very similar. You can take as an example part of your IRA and just say, I'm gonna do an income focused IRA or what's called preservation of principal. That means your money is literally preserved.
Yeah.
And just leave it there. But yeah, we offer brokered CDs for those clients who have a lower risk tolerance or just simply have cash sitting on the sidelines waiting not earning very much at their bank.
Exactly.
And then there's other ways such as, bonds. I mean, and I have folks who just, all we do is increase their emergency savings. We connect their bank account, Edward Jones account with their bank account, and we just pull money every month and increase their savings just in a money market fund. And the money market fund is not tied to the stock market.
Right.
But it does pay.
Hi, Guillermo, it's Terry. What about the opposite? When you're, is there like a minimum, you must hold this in this account for 6 months or a year or?
I'm sorry, repeat your question, Terry?
On your previous example, where you're switching funds to gain, what if you're losing and you want to switch out of the fund some way or another? Is there like a, period of time that the money has to be in the fund?
No, so with mutual funds, so there is one, so almost always mutual funds, there is no penalty to sell with one exception. And it's very, very small. There are situations which if somebody has enough money, they can go into a fund of family at zero commission. Like you don't pay me a dime in commission, but these are fairly large. So in some of them, it's like 250,000. In those cases, if somebody pulls money out of those funds or out of that fund family within 12 months, you pay a 1% penalty. But that's the only time where there is actually a penalty to sell out of a mutual fund. Almost always there's no penalty to sell out of a mutual fund.
Right.
We have a hand up. That was Maria raised her hand. I think that we have another question in the chat box as well. Maria, would you like to ask your question if it has already have not been answered?
Yes, when it comes to taxing money that we lose, is that something, well, maybe that Terry will answer, but is that something, because, I've lost about 6,000 already. So do I put that on my taxes as a loss?
Well, so it depends on if it's I believe that your accounts are only retirement accounts. So you don't have to worry about. So remember, in retirement accounts, when they go up, we don't pay taxes. When they go down, we don't benefit from the tax loss. And so now if it's a non-retirement account, like a regular standard brokerage account, then yes. But it also depends on what the client has inside of that inside of that brokerage account. But if it's a Roth or a traditional IRA or an annuity that's tax deferred, you don't have to worry about taxes until you take the money out.
Sorry, Isabel. I had a question on that with, let's say it's in a Roth IRA. And basically the income has already been taxed. So if there's a loss, would you still get the like $3,000 loss deduction or?
No, because Roth IRAs, literally we have no, like when it's tax time, somebody has a Roth IRA, they don't get a tax form from us because it doesn't matter if it's a loss or a gain. Roth IRAs are, when they say after tax, that means that there's no tax benefit if there's a decline or tax bill if there's an increase. The only times I've seen that there's penalties with Roth IRAs is if somebody contributes to a Roth IRA and they are above their income limit. And I've had a couple of clients like that. And that's when I sent them to Terry Larry to make sure that they know how much, their it's called adjustable gross income. That's what determines whether or not you can contribute to a Roth IRA.
Thank you. Okay, thank you. Did he answer your question, Terry? You're good?
Yeah, but there's a couple of things I probably look at, on my own.
Oh,
Yeah, or
But yeah, thank
call
you.
me.
Okay.
Call me.
We don't
Okay.
have any more questions for Guillermo. There's one more question in the chat box for Ricky. And it's Ricky's still present, correct?
Yes, I'm here.
Okay, the question, are there resources available to provide help with out-of-pocket expenses on prescription drugs not fully covered by Medicare?
There are. That's where the extra help comes in at. I'd say I tell everyone to apply. It can greatly reduce the cost of your prescription medications, and that would probably be your best option. Anything else, you could ask me offline, and I could direct you in some other routes as well.
Thank you. There's another hand up, Terry Larry.
This might be one of the things Ricky wants to talk about offline, but I have this situation where my mother used to live in Vegas. She moved with me to California. And so, picking a healthcare plan and all of that stuff is not my forte. So would we ask you, or would you have to refer us to someone?
No, I mean, I can certainly assist you. Specific questions like that, you could I'll send you my contact information, and feel free to call me, text me, or email me, and we set a time to talk and go over all the details of what you need.
Thanks.
You're welcome.
okay. Are there any other questions? If not, that will pretty much conclude our webinar tonight. I really want to thank everyone that came out this evening. I hope the information was great for you. I want to thank our speakers, Rickey Hodges, presenting on the Medicare open enrollment, and Obamacare. I'm Obamacare. Okay, covered California. I hope that he was able to answer your questions, and you got some of the information that you need. People are always asking, about an open enrollment. How do I do this? And it's so much information out there. So it really helps to have someone you can talk to. And I think you did a great job for that. And we thank you, Ricky. Guillermo, you did an awesome job talking about the market, some of the investments. So if you guys have questions, I'm sure the information's in the chat box. Be sure to give them a call to get, whatever else is on your mind, get it answered, because they are a wealth of information. Financial services is really a big area, and there's so much going on right now, and our money matters. And it really matters to know what's happening to your money, where is it going, as well as our health, financial situation. And that's why we have these webinars. So we want to thank you again. I thank you, Vernell Taylor, for your help tonight and all that you've done on the webinar. I thank you, Lorraine. And I just thank everyone for being here. I hope that you got a wealth of information tonight. Make sure you jot the numbers down, because something may come to you that you didn't have on your mind tonight, but you'll know exactly who you can call and who you can contact.
Could you put the numbers up again?
Okay, it's in our chat box. The numbers in the chat box.
Yeah, so before we sign off, make sure everyone gets the opportunity to get the information. So I'm gonna just put information in, and Ricky, maybe you want to send yours in one more time, because yours might be at the top, just so we can refresh the chat box. Let's sure that everybody get the information. I appreciate it. Thank you.
Okay.
Yeah, I just
Yeah.
put mine in again. I mean,
Excellent.
Okay.
her.
Thank you.
And just so
All the
folks are aware,
information there.
I apologize.